looking at like where rates are going to go, you got to look at which ones you're talking about, right? Like, are you doing construction loan, bridge loan, all that stuff, or is it really like a fixed rate mortgage? As far as the Fed funds rate, like the Fed's kind of in this like weird stuck position, this like stagflationary stuck position, right? So they have two things that they're contending with. It's like their dual mandates, like full employment and then inflation. You have downward risk, right, in employment, right? So you have like risk that like the unemployment rate goes up, but you also have inflation risk. Those two things, they would be different reactions, right? So if the labor market got hit, the Fed would lower rates. If inflation goes up, the Fed raises rates. Which one becomes worse? Welcome to another episode of Straight Up Chicago Investor Podcast. I'm your guest, Jake Clopton, and with me as always is your hosts, Tom and Mark.
I'll take it.
Acceptable.
All right.
You threw the paper.
He did not want to do it, so let's get him off the hook here.
No, what are you talking about? You offered to do it in another language. You said
Do it in Mandarin if you want. Yeah, let's do it.
that was awesome.
Oh, man. Learned a lot about the economy. Something I probably should know more about. I
Yeah.
feel like...
You know what's funny? I was thinking about when we're actually recording this. Like, I kind of BS my way through a lot of these conversations when it comes to the economy, and I kind of have enough to be dangerous, but I don't know enough of the underlying. So he helped me understand more today as well too.
Yeah. You personally, like at GC, are you guys still full steam ahead? Do you have any hesitation right now, or is it still pure growth mode?
Property management is a down economy industry. So think about this: when the market's hot and everybody's prices are high, people are like, "Oh, so I get $100,000, or I'll cash out, or I've owned it for 10 years, or they'll roll it into something else." But for us, when the market's down, that's actually where people are like, I don't know if I should. We talked about in the episode the indecisiveness of people right now and the unknowns, and that's where people are like, I'm just gonna hold on to this property and I will I'll have somebody manage it for me. So it's good. So I'm not saying it's good that when the economy's down, but it's good for our business at least.
Well, it's also like how you guys got started, right? Like in whatever, like people got stuck with properties and needed someone to manage them.
Well, anyone that knows our story knows I never intended to be a property management company. So it was kind of an accident where we took on the first few people as a means to an end for the brokerage. And then when the economy crashed, it's like all of a sudden we had 300 doors we're managing. It's like, but again, it was still, the only reason we really kind of systematized it was we're like, shit, we don't have any systems and we manage 300 doors and 500,000 square feet of commercial space. Like, so, but yeah, no, it's for us, it's all good. And we like this kind of environment for the property management side of things. For the investment side, it's tougher for us.
Yep, absolutely. All right, we're talking about property management. What's our housing provider tip of the week?
All right, so our housing provider tip of the week is when emergency work orders usually come in between 5 at night and 6 o'clock the next morning. So keep this in mind when you have an emergency. It's not always an emergency that has to be solved in the next 4 hours. If hot water goes out at 8 o'clock at night, you don't have to run a guy over there. You can have them lined up at 7 o'clock the next morning. If AC goes out at 6 o'clock at night and it's moderately, you don't have to run your guy over there right away. You could line up for 6 o'clock the next morning, 7 o'clock the next morning. So now don't let things go on for days. But the key part of this is you don't have to spend the extra money to service, to get this emergency service out that night, pay time and a half, pay an after hours charge if you have a good rapport and good communication with a client. Most clients can understand, listen, I can't get a plumber there tonight for hot water, but I promise you I'll have someone there. Now, as long as you show up the next morning with them there, first thing in the morning, you solve the problem, that's awesome. Usually you're going to get their understanding. But a lot of it ends up being communication. They put in the no hot water, you don't respond back. Then when you don't respond back, they call again and you might miss their call. So now all of a sudden it sets this motion of uncertainty, topic of today's episode, into their mind, and they're concerned at that point. And now they're starting to worry. Now they're starting to get mad. Now they're thinking, I pay $2,000 a month, I can't even get it, and this is the first work order I put in. So all these things start going. So be responsive, communicate what you're going to do, and follow through what you do. And you don't have to go solve that problem and pay the extra money that night.
Good stuff. All right, let's bring in our guest.
All right, I'm going to let our guest today kind of introduce himself because he's got his hands in so many different things, and we're going to talk a lot about the economy because this guy's been on dozens of podcasts and TV interviews and news interviews that are everywhere right now, it seems like, over the last 3 years. But the theme I would put out there is your specialty is when everyone's running out of a burning building, you like to run towards it. You put yourself out there, you take risks. You're
counterintuitive.
You're exactly what that entrepreneurial spirit, that risk taker, but always kind of understand your exits to get at. So I'm always excited to talk to someone like yourself. So
yeah, appreciate it.
But let our listeners know kind of who you are, so to get familiar.
I'm Jake Clopton. I got into real estate. So I used to trade interbank hedging products, and I'm going to date myself here. I used to trade LIBOR, which no longer exists, right? It's SOFR now. And it's kind of going along with the counterintuitive thing. I got out of that in 2008-9 era when the credit crisis was going on. And my idea was to start an intermediary that was based around credit, right? So, but the thing about entering an industry when there's disruption and all this stuff is, the barriers of entry are much, much, much lower, right? A lot of the incumbent people are gone, and people are looking for new resources and, to network more to get be able to do the things they used to do, which they no longer can. And they're much more open to talking to people and building new relationships. So when you enter an industry and everything, it's at the height, everything's super saturated and it's so hard to get anybody to talk to you. But if you enter in during a crisis, then everybody, is more than willing to meet new people and to look at new avenues that they wouldn't have before.
When things are at the top, man, everyone's got a guy, everything's flowing along. They don't want to break that.
Yeah, exactly. Yeah, everybody's got a guy, right, that they've been working with. That, they think they have a relationship until they don't. So, I got involved in. It wasn't really my idea was to help people find loans and credit because nobody could. And at the time, you would just kind of find somebody that was lending, and people would just come to you. And it wasn't just real estate at first. I remember doing even some semi-truck loans and stuff back then, but it quickly became real estate because I think I just jived well with the people in the industry. I was very entrepreneurial and it just worked well with my personality. So we ended up really focusing on just real estate, and that was a lot of years ago. But now we besides just financing, we're an insurance agency and we're a sales brokerage, and really try to become a commercial real estate services firm. I still do financing every day, but the way I came up with the services thing is, twofold. One, it's all the same people, right? So trying to monetize contacts in different ways. But I really candidly just took a look at a HUD statement one day, and I was like, fuck, are all these other people in here, making money? So I was really trying to capture the whole thing and, be able to offer, our clients more of a one-stop shop to be able to do these things all together than having to piece together 12 different people. Because half the time I'm calling the insurance guy. I'm like, dude, where is this stuff? But having it all in-house helps so much, especially on finance and insurance, because those things just go hand in hand so well. So
I get my chops busted all the time for calling it HUD statements, though. That's not even what it's called. So you definitely.
Oh, closing statement.
They did away with that name.
So there's, you started kind of almost as the middleman, as a broker here, correct?
Yep.
So a lot of our listeners are probably well, I have 3 contacts at 3 banks. Why would I ever go to a broker? What's the value that person can add? So I can answer that question for the handful of listeners who have that mindset.
Okay, conceptually, right? Just talk about experience-wise. If you're an owner of real estate, and you do it by yourself, how many loans will you end up applying for over time? Maybe a handful, something like that. I do that every day. This is all I've done for 20 years, right? And just our process in general and my experience dealing with banks and everything. I can explain this pretty well. When I take a loan out to the market, right? And we deal with tons of banks and stuff like that. One, it's incredibly time consuming, to actually get through to local regional banks and, get these guys to actually call you back. Half these guys barely graduated high school. No, I'm kidding. No, they're great. But, getting through to them, just call up a retail branch. Say hey, I want to talk to a commercial loan officer. They're like, what? When we take a loan out, I will talk to at least 200 bankers in every deal. Doesn't matter what the size is. It's just our process. We built up a network nationwide that does this stuff. The other interesting concept is you said they'll talk to 2 to 3 bankers. I'll talk to 2 to 3 bankers minimum at every bank, and I'll get 3 different answers.
Yeah.
One guy will be no, we'll never do that. The other guy's out on paternity leave or something. And then the next guy's oh, I've got a great relationship with my my chief credit officer. I just did a deal like this, slam dunk. And I'm this makes no sense. But you just have, if you're not talking to more than one person, you know what I mean? You're really missing out, because at the end of the day, this business, even though it is finance and it's a lot of math, not a lot of math, but it's numbers, but it's still all just people. And just because you call some guy up at a bank, he just may not want to deal with you and he'll just say no. So really talking to multiple people at the same institution definitely matters.
Yeah, it's funny just even going to these mid-level size banks, like just where they are with liquidity. Like you can go to them in the spring, go back to them in the fall, and like their appetite can be completely different. Like the deal could be exactly the same. It'll just be like, no, our balance sheet is now here.
100%.
Yeah, it's
so
nuts.
All these banks are regulated, right? And they have portfolio concentrations and makeups and all this stuff. And it's not like a credit card, right? I mean, you can always get a credit card when you get a credit, but like commercial real estate lending is different, and their portfolios are rated differently, and their liquidity ratios change. And I mean, just to give you an idea, I marketed it's like $15 million like assisted living facility in January, and got like a couple of guys to look at it, didn't get great terms. I marketed the same deal in March. We're about to get a commitment letter, in like a week, to the same people, right? It was just so happened, like, I found a bucket of liquidity that opened up at a bank that wasn't there before, because they had a payoff, and also like they had their new allocations for the year, stuff like that. So it definitely matters, not only like who you end up talking to, but like when you end up talking to them. You know what I mean? So I always tell people, like, hey, if you hear no the first time, as long as you're not asking something outrageous, like 100% financing or something, like, keep kind of looking for that answer, because a lot of times, like, you will end up finding it. If it's not like right now, it might be 3 months from now, right? It just depends. It's a little bit of luck and opportunity involved.
Are you putting it only out to banks, or what other sources are out there?
No. So we do a lot. 70% of all the commercial real estate lending is banks, right? It's just the largest, pool that's out there. And every one of them has different terms. Candidly, they all really do. We put stuff out also to like private debt funds, life insurance companies, stuff like that. But private debt fund lending, yeah, sure. We do a lot of like construction and bridge debt through those guys. But like not as much really life co lending. They're not as big a piece of the pie as people think. And you can get some great terms out of them, but for the most part, like if you're in acquisition mode and you're growing and you want like higher leverage, they're not the best, guys out there. And they really want like institutional guys. And like my guys, like the guys I deal with, are small to middle market, right? Like most of our loans are 5 to 15. I mean, we do lower than that. So they really fit well for like local bank lending, stuff like that.
Yep. We've kind of glossed over like to present day, but talk about just building this up in 08, 09. Like this is very impressive. Like it's a time when lending is probably not the greatest thing to get into, right? And it's just you at this point running around, I'm assuming. Like talk to us about just those just early years of just how did you get it from, maybe take us from like 09 to 2012 or whatever it was, where all of a sudden you have a team.
I can tell you it was 100% me sitting in my apartment making cold calls. That's all I did all day long, literally just sitting on the phone, calling nonstop like anybody. I still do cold calls just to keep that skill up, but I think that's just the number one skill anybody could have is just, cold call, network, build those relationships, all that stuff. Like, I just don't understand how else you're planning on, like, over LinkedIn. Like, no, like, you need to cold call people. You need to build those networks. And I think I made, it must have been like 300 calls a day.
Yeah.
Anybody I could find, banks, credit companies.
You didn't have deals to offer them. You're just saying like, hey, I'd like to add you to my
building
arsenal.
Relationships, stuff like that. We had deals. I mean, at the time there were so many deals. Not a lot of them were great. But yeah, I mean, it really built the business up over cold calling. And then, to me, it was kind of natural. I didn't really have that like cold calling anxiety like a lot of people did. Like I had this one guy that worked for me that he would do like one phone call and then need to go like smoke a cigarette and circle the block and then come back to another one. But I would say anybody that's trying to break an industry, like cold calling is by far and above the most effective and efficient way to like build that network.
The hardest thing for me is always that first phone call, just getting that first phone call done. And you almost have to plan who you're going to call, because then you get lost in, should I call this guy? Should I call this guy? You have to for me, I have to have a list, and I can just once I have that list, I just rattle.
Yeah. I think a lot of people think you need like this script and stuff, you know what I mean? And like, I'm like, dude, what do
you got to perform the action.
The number. It's just a noise on the other end of a phone. Yeah. You know what I mean? Like, don't take it personally. The guys that know you. Every once in a while you got to go after yourself, but like, it's fine. You just move on with your life. So.
Yeah. All right. So then, at what point does this become more than just the Jake Show?
Yeah. So, I think once I got to the point where I started realizing, that like I was kind of holding myself back by not delegating things as opposed to like trying to do it all myself. So we went through a couple iterations of like trying to scale. One was like I built up a large like origination team. This is when we were just doing finance, right? Built up like a large origination team of guys that are in-house and then like some like foreign people as well. Turns out I don't like human resources that much. And like
the guy who makes 300 cold calls a day is usually not the guy who's doing accounting and HR. Just
Man,
that Venn diagram is small.
Deal with like employment tax in the Illinois Department of Employment. Oh, I'm sure you guys have dealt with that. Like, I'm good. So really like try to figure out like different ways to scale this model and stuff like that without having to deal with all that. So for the time. Like now I've expanded these different verticals mainly through like partnerships with people that are running those sides. Like I don't run the insurance company. I don't run the 1031 stuff, right? We have like, I've put together like joint venture partnerships with these guys and everybody's self-motivated and it's great, right? I mean, it all integrates and works hand in hand. On the finance side, I built more of a like back end of not like originators, but like processing staff and stuff like that. But then we also like one thing I'm doing right now is really trying to expand through like affiliate network. You know what I mean? Like use our brand, our authority over 20 years of doing what we're doing, right? And like have people kind of bring us deals and then we just do the whole thing in the back end because we've got the efficient process down. So that's what I think is kind of the next step for us is to try to like expand this affiliate network as wide as we can.
Got it. What getting started on this, like there's not a ton of capital needed, right? Like for our listeners out there who might be interested, like this is tough, it's a grind, it takes a lot of effort, but you're not fronting a ton of money on because it's almost like the wholesaler in the situation, right? Like you're putting two people together and there's not a lot of upfront cost for you. Is that accurate or no? There's
not. I would say there's cheap ways to do it and expensive ways to do it. You know what I mean? Just like anything. The more difficult part is like knowing how to find commercial real estate owners because you guys notoriously like to hide yourselves, like we all do, right? And so it took a long time to figure out like what's the best way to get through like all the corporate structure and then skip trace and then all this stuff. You know what I mean?
And then when you do talk to that guy, he's already got a lender.
I mean,
right? Like,
maybe not.
But you do all that work just to potentially tell him that F off. Like, right? Like it's a lot of.
So there's expensive ways to buy data, like CMBS loan data and all this stuff, and like. But I mean, realistically, like no. I mean, it's not a huge barrier to entry. I wouldn't say anything is particularly a huge barrier to entry if you just got to be willing to put in the time. And commercial real estate is like a really long sales cycle. If you want to put it that way. Like I have all these like lead companies call me up every once in a while, like, oh, what's your sales cycle? I don't know. Like I had this one guy I talked to for like 9 years before I did a loan for, you know what I mean? Like, but you've just got to be in the business for that long. And then you kind of get this like gravity that comes to you, just because you've been around for so long. So I think the real cost is being able and willing to put in that amount of effort for that long. Because I think it was over a year like back in 2008-9 before I closed my first deal. And that was like a long time to go.
And like
not having a lot of, income coming in 20 years ago.
Yeah, everyone just gives up though after 60 days. Like that's the problem, right? Like it takes a year to get to that first deal, and
it does.
People buy the list, they don't get a deal in 3 months. They're like, this sucks, and let's go do something else.
It's like that tipping point thing, right? Like also in commercial real estate, where like you've got to make enough mistakes, you got to work on enough things to like that didn't go anywhere to know what's actually going to work. And it's really hard to like educate somebody on that just on a piece of paper. You have to have the experience of doing it. Like now I'm at the point where I feel like I get on the phone with somebody and I can just tell by their tone of voice within about 10. I mean, you probably get into it, right? Like, this is worth it. But whatever. But like knowing, I think like the most valuable skill is like knowing what to put your attention towards, like knowing what to work on. Because if I can eliminate all this noise and garbage that's not going to go anywhere and just put effort towards things that are going to like actually net me money, then that's a big plus.
Yep. Was there a deal that sticks out as like that tipping point? Like that, whether it would be like, man, your back was against the wall, or just a huge deal. Like, was there one that you look back fondly on of like, I've arrived?
I do remember one in particular back in the day. That was it was a good point in time that I realized my name was getting out there pretty well, because it was this $14 million deal. The guy was in Mississippi, and he found us and was referred to me. And this was like 2-3 years in, something like that. And I was like, okay, this is starting to get somewhere and build on itself, because he came to me through word of mouth of all of the outreach that I've done. Pretty good sized deal, right? For then $14 million, and we did end up closing it. So that's one that really sticks out for me real well, because that was the first time the efforts circled back around.
Yeah. You get the reactionary.
Yeah, and it wasn't like $100. So.
Yeah.
Man, all right. So from reading up on you, you know a ton about just you're smarter than both Mark and I on just supply and demand, tariffs, the economy.
I don't know about that, man.
No, it's a low bar. It's a pretty low bar. Yeah. Where do we want to start here? Should we talk about interest rates? Like, we're recording this. This is May 20 something that we're recording this. Let's talk about rates. Like, what do you see happening here? It's the question we always get asked too, and like, I don't have a damn clue. I just go out there and do my thing.
Right. So, I mean, there's a couple of different things. Like, when you're talking about rates and you're talking about like the yield curve, right?
Yeah, break some of that stuff down.
There's two different, the easiest way to look at it is there's two different sides of rates, right? And it depends on what kind of loan you're doing. There's short-term rates, right? That's your SOFR, Fed funds, all this stuff. If you're doing any short-term strategy, like a bridge loan or construction loan or something like that, you're going to be tied to short-term rates.
Yep.
And those are primarily based on the way the Fed is going to move, right? So if they're going to lower the Fed funds rate, raise the Fed, all this stuff, right? And I think a lot of people struggle with this, like, oh, the Fed lowered rates, but like mortgage rates didn't go anywhere. Well, that's the other end of the curve, right? So that's the 5, 7, 10-year products. And those, the Fed doesn't directly affect those unless they do things like go in and remember the quantitative easing thing? That was them going in and buying bonds. And they're not doing that. Right now, they're actually doing the opposite of that. So those rates, there's actually like upward pressure on those rates as the Fed's kind of holding steady in Fed funds rate. So when you're looking at like where rates are gonna go, you got to look at which ones you're talking about, right? Like, are you doing construction loan, bridge loan, all that stuff, or is it really like a fixed rate mortgage? I think I could handle the two different parts.
Let's do it.
Yeah, as far as the Fed funds rate, like the Fed's kind of in this like weird stuck position, this like stagflationary stuck position, right? So they have two things that they're contending with. It's like their dual mandates, like full employment and then inflation, and you have downward risk, right, in employment, right? So you have like risk that like the unemployment rate goes up, but you also have inflation risk, meaning like, where like people are thinking inflation is going to keep going up. But those two things, they would be different reactions, right? So if the labor market got hit, the Fed would lower rates. If inflation goes up, the Fed raises rates. And so it's like, which one becomes worse, right? So at the end of last year, the Fed lowered rates like 100 basis points. That's because the labor market was starting to get hit pretty bad and inflation was coming in. But then they stopped because right now labor is so strong and the economy is doing well, but inflation's starting to come back pretty good, through tariffs and all this stuff.
We don't ever talk about this. The employment rate right now, where it's at. Give it kind of like a 10-year horizon of where it's been and where it's at today.
We're at effectively full employment, right? What is it, like 4.5%, something like that?
Yeah.
It was a lot lower. Think about it, like during COVID, the employment rate was so low that the labor dynamic changed. Whereas the people looking for jobs had the power in the hiring process. So much so that we ended up with a work from home economy because they could say, I don't want to go into the office. Look at what's happening in the headlines now. Now it's all return to office. So that's flipped, right? Now, the power's gone back to employers, not employees. So now we're seeing like everybody say like, hey, either come to the office or you won't have a job. So
for context, where were we at in 2010? It was like 9-10%, right?
During the crisis?
What was the highest it got back then, I guess? That's longer
I
than 10
remember.
years.
Yeah, something like
that. I feel
that.
like it was like in the 9-10%.
It was pretty high. I remember watching like reality shows of people like giving up on life and moving to Hawaii. Yeah, it was
pretty high. Just hearing like job reports of like, 100,000 jobs left, 400,000 jobs lost. Like it was just crazy the amount of people.
Yeah. Well, think about like a lot of those companies, they paid their employees through credit and a lot of their credit lines, all stuff, and they lost all those.
Yeah.
So they had to
overnight
give those employees overnight.
And a healthy, I think you just said it, is right around 4%. If you go lower than 4%, then that becomes a problem as well too.
I mean, we're effectively at full employment right now, right?
That's
So
right
if it goes more, they might say like, hey, the economy's overheating, and we might have raised rates. But right now, I think there's more risk to unemployment rising than lowering. As far as like long-term rates, there's two things that are really affecting it right now that are in the headlines. One is tariffs and inflation, right? So inflation expectations will raise long-term rates, right? And those products those mortgage rates are based primarily on treasuries, and those float every day, right? So more inflation expectations, higher interest rates.
And that's just expecting inflation. That's not even actual inflation happening.
Right, so watching expectation, right? Well, because think about it, you're talking about something that has a duration of 5 years. So it's your expectations of inflation over 5 years.
Gotcha.
The other thing is, credit rating of U.S. debt. So when Moody's just downgraded the U.S. Treasury debt from like AAA to AA1 or whatever it was, that actually has a huge ripple effect to the economy because that your treasury rates are your risk-free rate, and so everything below there adjusts also. And then so much so that like deposits at large banks just got their credit ratings downgraded because the government backs those, and the government's credit rating came down. So it kind of has this ripple effect through everything. And so like when you have more perceived risk in the system, you demand a higher return. So rates have gone up quite a bit, right? So the 30-year Treasury jumped up over 5% like yesterday from the downgrade.
This might be an opinion question, but we talk about expectations or predict. There's always a lot of predicting in these conversations of what's going to happen. That turns the everyday person's mindset into like fear. Like, how much of these problems are real versus how much is it just because of talk and media and all that? Opinion-wise,
it's a good question. So a lot of it's jawboning, right? And the Fed actually uses that as like a tool, right? They'll come out and they'll say something, and it kind of affects expectations, and that does move markets, right? There's a lot of uncertainty, and that's the key word right now in the economy, like uncertainty. You don't know what's going to happen. I mean, every day, like something else comes out, and I try to tell people this too. They're like, "Where do you think rates are going to go?" And I don't know. I used to trade interest rates for a living. I can tell you where rates are going to go today, but something might happen tomorrow that can completely flip the script, and it'll be a totally different game. And that's just kind of how it goes. So when we're talking about, and I know it matters. I know it matters for cap rates. I know it matters for how you're gonna evaluate your deals. But you got to make this decision in your head whether you're a real estate operator or an interest rate trader. That's what I tell people. I'm like, it's got to work where it is today, and you can't have this like paralysis because you think, the rates are gonna come down in a year or two or something like that. I think that's the healthiest way to look at it.
Yeah, and we have so many listeners in the 2 to 4 space, so they're dealing with your Fannie Freddie type mortgages or FHA or whatever it may be, and so many of them sitting there saying, "I'm going to wait for rates to drop. I'm going to wait for rates to drop," and it's like, all right, well, what's going to happen? That house that's $700K right now, what's going to happen when rates drop?
Yeah,
right. Like where you?
Well,
it's what's going to happen? Like it's just you're going to pay you're going to pay a premium. Like
anybody that's in that space, like I do think residential housing is probably one of the best plays right now. Like residential housing rentals. Right, because you've got such strong demographics for housing, and you have such strong constraints around construction. Right, you've got a cost of capital that's high. You've got tariffs, which I don't know if you guys have ever built anything, but like tariffs and all this stuff, it just creates uncertainty, and construction hates uncertainty, right? Because it just makes giving GMPs impossible. Your contingencies blow out. That's how you get like busted deals. And so it's just Chicago's hard to build anything anyways, but it's just so hard to build anything around here and like everywhere basically. So you have, super high demographic demand for housing. You've got really expensive, cost of capital, all this stuff. And I think, a couple of weeks ago, there was this statistic. There was only 2 major metros in the country where it was more affordable to buy a house than rent. I think that's over. It's like Detroit and Philadelphia. I think those have flipped now. I think in every single top 50 major metro, it's now more affordable to rent than buy. So that means, like so many people are getting pushed in the rental market. And so like as far as like, Chicago, I was at the Lincoln Park Builders Club the other day. I mean, I can tell you those guys were like, we don't even need leasing brokers anymore.
Yeah.
Like, I mean, it's to the point where we don't. I mean, the place is rented before we even know there's going to be a vacancy. You know, so it's. I think, you know, if you get into the residential space, you're going to see a lot of appreciation in asset value and then just really strong demand on the rental side.
You're doing $500,000 rehabs. Are you seeing anything on tariffs or anything like that that's hurting you, or is there stalled out?
We are underwriting differently for something we're looking at today. For projects in flux, like they haven't seen anything. For the projects going on right now, we have not seen anything yet.
So you haven't seen it, but you're planning for it.
Correct.
It's the uncertainty.
I'm preparing myself.
Right.
Jason Marcotis brought me a deal, and like we ended up punting on it. We were going to partner on it, and it was just too many. It was like one of those iffy deals where like maybe 6 months ago or a year ago we might have said, let's roll some dice, and like we didn't. Like it was just all the uncertainty. Like, is this rehab going to be 450 or 550? And knowing like I don't even have. There's uncertainty when you do a deal regardless, right? Like just all the things that happen, and then the things you can't control on top of that, it makes it like, well, I don't need it that bad. Let's wait for the next one.
Are you just like padding the contingency? Like,
yeah, just we're assuming like, all right, if we spend $40,000 on framing on the last two projects, we spend 40 and 42. The next time, let's underwrite it at 48, right? And like that doesn't sound like a big deal. But you got 40 line items doing the same thing, and all of a sudden there's another $100,000 there.
I think there's more uncertainty than just price in construction materials now. I think there's uncertainty about whether or not it'll actually even be there when you go to Home Depot to get it.
Yep.
That's the biggest risk, right? It's like, hey, I couldn't even pay for this stuff if I wanted to because the ships just aren't coming into the ports.
We built our house during COVID, and I do this for a living, and my wife's like, how the fuck do we not have a stove? And I was like, I don't like, there's nothing else I can do here. Like, I don't know what to tell you. like
we could build a fire.
I'll get you a temple, and it's going to be not what you wanted. No, but like the uncertainty there. And then, luckily we do very high end, like, we'll sell like a $2 million home type of thing.
Sure.
And, those buyers up to date in the last 5 years, they've always been there, right? They're immune to interest rates. Like that's FU money territory.
It's but like cash buyers, stuff like that.
Yeah. But like, it also at some point, will they not be there? Right. Does that guy say, I'm not doing that. I'm doing 1.5, or that person was upgraded from a 1.5 to a 2. And now they're thinking, oh, maybe not. Like there's also that uncertainty of, it's always been there, but that doesn't mean it always will be there.
Yeah. I was wondering about like that segment of the market too, because I think like during COVID when rates were at 0, there was no benefit to holding cash rate.
Correct. Like it was just.
But now some guys got like $2 million in your eyes. Like, well, maybe we'll just stick it in this money market fund and get 5%. Like.
Correct. Like the competition for that is now as opposed to
there's competition for cash in other places.
Yes.
Right. Yeah.
So it's interesting. Like we'll see. We got a lot of deals in progress though, so we'll see when this airs. Like, we'll see how happy or sad I am.
Well, I hope they're done by then.
So, what else? Like, if you had to take out your crystal ball right now, what are some predictions you would make for the real estate market, even if you want to do in general or the Chicago real estate market over the next, call it 12, 18 months?
Good question. I mean, just in general, like macro wise, which I'm better at the macro stuff, right? I think macro wise rates probably end up staying where they are. I think there's just as much push and pull on both sides. If anything, as far as the short term rates, I think there's actually more risk to the upside in the Fed having to contain inflation even more, because you've got long-term rates that kind of have this like risk of getting out of control. And they may need to, pull back or maybe do quantitative, something like that. So I think rates kind of probably stay where they are, and when everybody's expecting something to happen, it never happens. Like everybody's expecting rates to come down, it never happens. It usually goes the opposite direction. It's going to go whatever direction is going to cause the most pain, probably. Yeah. So, I mean, as far as cost of capital wise, I think we're just going to chug along in that area. As far as like banking and credit wise, the banks are fine. You know what I mean? And even like the small, like local and regional banks, like I talk to these guys every single day. They're not really constrained. I mean, last year I was getting lots of banks that would ask me for significant deposits just to do like Like it was literally like one bank asked for like 30% of a $10 million loan for deposit. Talking
yeah.
about? Yeah, I'm like, what are you talking about, man?
Just tell me
it's
no.
ridiculous. But no, I mean, I'm not really getting that answer anymore. So I think there's just a lot more healthier balance sheets out there. They're getting more payoffs.
Real quick before you go on, there's also been the narrative of 5 years ago, people taking out loans at 3% that are now coming due. Like, are you seeing any of those?
So the ones that the ones that are in trouble, which I think the ones that everybody points to, are the variable rate multifamily value add deals that were going off through these like CLO funds that were like 85% of cost. They were, it was not that there's anything wrong with the property, right? The property's fine. The problem was with the leverage and the economics, and also the concept of syndicators not having any money to come into the deal with themselves to right size the deal, right? So you had these deals that were, at the time, like the funds that were putting them out, they only made the guys that were putting out the managers, they only put money out and made money through origination fees. So it was just like put money out, right? And there was a lot of competition for deals. So they were 85% of costs, underwriting exits that were like 3.5% interest rates, and like rent growth continuing. We know none of those things happened, right? Rates went through the roof. Rent growth, especially in the Sunbelt areas, has come way down, if not like going backwards, right? So you have constraint, right? All the margin's gone. And then like the vast majority of those were syndicator deals, right? Where, it was all just raise money, and those guys don't have any money themselves. So I think that's the area of the market that everybody points to, where they point to people that are stuck. The weird thing is I have not really even seen a lot of those deals. I think I've seen a couple. The ones I saw that needed to move, the guys ended up just selling them and basically all their equity got, not their equity, their investors' equity. It's completely gone.
Yeah, I want to hit on this for a second, because what's crazy, like let's say you have a $10 million deal of syndication, and let's say you get a loan, it's $10 million all in costs, like purchase and rehab, whatever. If you're getting 85%, you only need 1.5 million, right? Like, so
it's not a lot of money.
It's not a lot of money. So if things just move a little bit, like the market goes down for everything you just mentioned, goes down 15%,
right?
100% of the equity is wiped out. Not 15% of like the investor's investment, like
100% of the equity.
all of it. Yeah, like all of it is gone.
How they're
like,
appraising it. Yeah.
Yeah, like that's what, if you're an LP and anything, that's what you got to pay attention to, is like, you're
leverage.
The first line to go.
Yeah, that's leverage for you.
I was talking to an LP last week, and his number one problem is buildings operating perfect, just like you said. Rents have not gone up as much, but that should not have killed them. It was taxes went up for that particular county, and insurance went up, which basically took them from.
Yeah, so he goes to refi, and then all of a sudden,
he went to refi. His appraisal was literally $5 million less than what he needed to be.
Yeah, that's a good point. The other other line item costs, in a lot of these deals, insurance is a huge issue now. I mean, insurance is getting so much of an issue; it's actually affecting property values, especially in like higher risk areas. But so we started our agency a couple of years ago to kind of like help that whole thing out, and also just made sense. But now I understand it a lot more. And insurance, the best way to put it is you got to, just like, remember like Obamacare? People were like, oh, I'm perfectly healthy. Why the hell am I paying these rates? I'm like, well, yeah, you got to offset the guys that are like, unhealthy. And it's the same thing in commercial property insurance, right? So when the California wildfires happened, it rippled through the entire industry. And like even us in Illinois felt that effect, because think about all the insurance policies. They go through these carriers and MGAs, and then up to the reinsurance companies. So it's all ends up being in the same pool. So they have to spread that risk premium out to everybody. And everywhere, everybody's seeing these increases. So the other thing about insurance today is back in the day, you used to just be able to like auto renew and all this stuff. You can't
inspections.
You can't do that anymore. You can't, like the days of just auto renew are over. You have to actively market this thing every single year to actually get a real premium, because we'll go in and like we'll get some guys auto renew and he's jumping 100%, and they give him 3 days to do it.
Yeah.
And we'll find a carrier that like just entered the market that's like half the price. So I mean, it really pays to market these policies every single year.
You bring up something important there, because the other day I always get asked for insurance referrals, But the other day they said, hey, do you got somebody that is only like in the Midwest that's not affected by all these things on the coast? And I said,
Doesn't work that way.
it doesn't work that way because ultimately I explained to them the whole reinsurance thing. Like the reinsurance companies usually insure things everywhere, which ultimately they're paying into, and that affects everything.
Right.
Am I right when I say that?
You're right. They have to spread the risk all over the place.
So even like someone that's isolated to the Midwest, they're still paying into a company that's exposed everywhere around the world. Even.
But also think about some of these areas like Florida, like high flood areas. Like how do you insure an expected total loss? You know, like you charge this guy the cost to rebuild a house every year. Like, you know, like I don't know how you do that. You know, I mean, so that's why a lot of these carriers just pulled out of all these areas.
Well, on top of it too, there's legislation that they couldn't raise their rates by X%. Like there's almost like rent control in California for insurance carriers
until they just change that.
Yeah,
and
now
let them raise it. Yeah,
now they realize like, now they just realize, oh shit, this doesn't work.
Yeah, I mean the other thing with insurance too is like, you know, all this stuff affects insurance, right? So when you have higher input costs, like just like construction, right? Because we've got to pay to rebuild it. And how the insurance companies got to model those rebuild costs, right? And the replacement costs. And it's the same thing as putting together a construction job. Like, how do I model insurance policy around tariffs and higher input costs and all this stuff, right? I mean, it just, they have to pad it more.
Yeah. You used the word a couple times, stagflation. Can you explain what that is?
Yeah, stagflation is basically, it's seen as almost like the worst case scenario for economy, right? It's persistently slow economic growth with inflation. And the reason why it's so difficult is because it has two different cures, right? So slow growth would mean the Fed would lower rates. Higher inflation would mean the Fed would raise rates. And this is where we are right now, right? And like they're kind of stuck, and they're going to be very data dependent, and they're always behind the curve because they're data dependent. But they've got to decide like which one is worse at the moment. So, I mean, there's a scenario where we see like a whipsaw effect of them lowering rates, then maybe raising them, or maybe like lowering rates and doing quantitative easing and all this stuff. Like, it's going to be interesting to see what happens.
Have we been in this territory before? Or is this completely uncharted because of all the money printed?
Yeah, we've been in I can't remember when stagflation was, maybe like the 80s or something like that. But yeah, I mean, they've been in this before, but we haven't been in a, you know, in a post-quantitative easing, you know, type of area before with the type of administration that's in there. That's also post-COVID. That's, you know, the other thing that we haven't been in before, you know, is, you know, especially with construct, like so much of our import costs in, you know, real estate come from, you know, trade, like foreign trade. And you've got like China, which, you know, they can throw themselves around a lot. So we haven't been in a scenario like that before in, you know, concerning trade with another player like that in the past. You know what I mean? And then also like people are using trade as basically like economic warfare now. And then there's also real wars going on. So there's, I don't know, there's a lot of geopolitical stuff that I think a lot of people haven't dealt with, you know, when it starts to combine with all these other issues.
Yep.
You are not from Chicago. You moved from New York?
New York, yeah.
You came to Chicago. You've been here for a while now. What do you like about Chicago? Or what do you like about it for real estate investing? What made you stay here? You ended up here because of trading, I think I heard. But,
yeah, so I'm from Rochester, New York. Then I went to school in Buffalo. Then I actually lived in Argentina for a couple of years. Then I moved to West Palm Beach, then here. And I moved here to trade futures, right? I ended up staying. I mean, I've moved around so much before. But like I do love Chicago. It's a great city. It's incredibly clean. I like that. And so like when my alternatives were like New York City or here, you know what I mean? And I was like, I don't know, Chicago's just such a beautiful city, and you know, there's so much the city offers. But I have 3 kids here now. So I have a 12, 10, and 6 year. Actually, no, 13, 11. The birthdays were just like a day ago. No, the birthdays were a day ago. So like, okay, 13, 11, and 6-year-old now. So yeah, I'm not going anywhere for a while. So as far as like Chicago real estate, one thing I really appreciate about Chicago real estate is it pays to learn the system around here. And I'll give you a great example. In that if you know how to take advantage of local incentives, like for instance, I bought a building over at like Laramie and Augusta, and I think one of the best plays in Chicago real estate is buying stuff from like long-term owners that like those guys would go there every day, and instead of replacing the hot water tanks, they would just fix it, or whatever. And the thing just hanging on by a thread for like 30 years, but it's so inefficient, right? You get like, a company like Elevate Energy to go in there and get like the utility incentives and stuff like that. And you basically get I got like $400,000 worth of all this energy efficiency stuff for free and turn that building around. I mean, that's just one good example of like knowing how to use all the government incentives around here. And I think that's how you make money in real estate in Chicago. You have to know how to play. Instead of fighting the city, you figure out how to work with them, right? Find out which areas are TIF districts. That's where they're putting money. Where the city tends to go to these different areas and say, hey, we're gonna redevelop. We're gonna push all the gangs out. We figure that stuff out. You know what I mean? If you're going along with them instead of fighting them, I think you can do really well.
It's so funny. People that complain about the city are usually, actually, let me reword this. People are usually not complaining when they're on the side of the city or they're getting away with the shit that you can get away with when you know the inside system of the city.
Well, it's like the same thing as when it's trade, man. Don't fight the Fed. You know what I mean? Yeah. Figure out what they're doing and go along for the ride. Yeah. Don't fight Chicago, man. You're not gonna win. Play the game. Do the tax, whatever stuff with the lawyers and do the energy efficiency incentives and figure out where they're developing. You can figure it out. You can make money. So.
Yeah, absolutely. All right, you mentioned the Fed. If you were in charge of the Feds, we put you in charge tomorrow because Mark and I have that power. What would you do? What would be the game plan? You're in charge.
Good question. I think they're playing the Fed funds rate probably the right way, right? Kind of seeing what happens. I do think the long-term rates are getting out of hand for two reasons. One, our interest payments on our government debt are getting out of hand, and that's affecting our credit rating, which is affecting everything, right? And then also, it's making that math problem of real estate deals really hard to make work. Real estate it's just math, really second grade math, right? It either works or it doesn't. And just the cost of capital, when it gets out of hand, these deals just get tight. And it's nothing wrong with the property at all, right? And it's the same level of debt. It's just, higher interest rate. So I'd probably stop letting their bonds roll off and maybe reinstitute some sort of quantitative easing or something like that. But the problem is that would cause more inflation. So that's why we're in this stuck position, right? So it's which one's worse?
Cool.
Yeah.
You're just happy you don't have to figure it out.
I think it's a really hard position, and no matter what they do, they're gonna be told they're doing the wrong thing.
Yeah. All right, you ready to wrap?
Ready to wrap?
Let's do it.
Cool.
What's your competitive advantage? How have you been able to do this while so many other people wish they could accomplish what you've done?
With a lot of the stuff that I highlighted, one, getting started, being able to enter an industry when there was a crisis going on and taking advantage of that, cold calling. And then, I think the thing that we do differently more than anybody, and I tell people this is how we differentiate ourselves, is the massive amount of outreach and banks that we'll talk to on every single deal.
Yep. All right. You mentioned a lot of good advice already, but what is one piece of advice you would tell someone that is yet to buy their first property here in the Chicagoland area?
This is the number one I always say is that real estate is a business and it's not an investment. And if you treat it that way, and if you treat your tenants like customers and not just tenants, right? And you go into it with that mindset, I think you'll do pretty well. The people that I see that run into trouble are the ones that know the term mailbox money. You know what I mean? So if you treat it like a business, you pay attention to it and learn it that way, I think you'll do well.
What do you do for fun?
What I do? Play with my kids. I long distance run, 10Ks every couple of days, and read some books.
Nice. Ooh, good lead-in. What is a good book, podcast, or self-development activity you'd recommend to our listeners?
My favorite book and somebody I follow on Instagram religiously is Chris Voss.
Does Never Split the Difference?
Yes.
Yeah.
There's not a lot of books that I can institute what I learned from that into everyday life and the way I actually even speak to people. So I would say that one. Absolutely, everybody should read that.
His masterclass is good too. It's some
awesome.
different stuff as well too.
Yeah, absolutely.
Side note, do you remember we tried to have him on and I forgot what his speaking fee was, and then we tried negotiating with him?
Yeah. I think that's his I'm like,
How'd that go?
Haven't had him on yet.
I'm not going to split the difference, but I'm going to offer you about 25% of what you need.
Yeah.
That's awesome.
I totally for the next question. Other than yourself, name a valuable Chicago resource for Chicago real estate investors.
Elevate Energy.
Okay.
Absolutely. They give you free like energy efficiency upgrades. You can access all the utility rebates and all this stuff. Like I said, I bought this. I bought like a $500,000 buildings, like 8 units or something like that, and I think I got like $300,000 worth of upgrades from them for free.
Yeah.
And that's real money. Not only if equity in the property, but it lowered all the utility costs significantly. The biggest thing with Chicago properties is utility costs, because you've got old, like radiators and stuff's expensive, right? So anything helps.
Yeah. We use, so Drexel's used that a few times. And for our listeners out there, I believe it needs to be 3 units or more. I could be wrong on this. And then they also have it where if you're in different areas, you have like higher rebates. So like, Augusta and Laramie,
like lower income stuff.
Like what you mentioned, like that'll get a higher rebate than Lakeview. Like they have they have some sort of geo, but like it's crazy because we had we got blown in insulation, we got all the pipes wrapped, we got thermal control for all the boilers, hot water tank, circulating pumps for those. Like it was all the fridges can be replaced if they're I forgot like the age on them, but like
they'll replace the light bulb.
All of it, the fixture, like it's pretty nuts. Like they actually dig into it.
It's shocking how much lower the utility and the gas bills are after that.
Yeah, because you're doing everything.
Shocking. Yeah. I mean, I think it cut ours in like a quarter or something.
Yeah. So, all right. Well, awesome. Jake, you provided a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
I'm always open for a conversation. And I am exceptionally easy to find. Just Google my name, call our company, shoot me an email, LinkedIn. I think I hit the end of the internet on LinkedIn. I've like maxed out my connections, so you can definitely find me. I'm always happy to have a conversation.
All right. Chicago Fact, who are we playing for? Who's our sponsor?
Today's sponsor is Cost Seg Kev. What's his company's name even? Everyone shows him as Cost Seg Kev.
Cost Seg Kev.
All right, we'll go with that. Cost Seg Kev Inc. There you go. We gave you a company. All right, so today's sponsor, Cost Seg Kev. We're playing for Sam Hopkins, who bought a shirt on the Straight Up Chicago merch store. And Sam, if myself or Jake is right, you get $50 gift card brought to you by Cost Seg Kev Inc.
All right. We should probably give him a real company shout out, but okay.
We're doing trivia?
Oh, yeah. Oh, yeah, baby. All right. All these are true facts about Chicago during World War II, except, so 3 of the 4 are going to be true. You got to tell me the false statement. Chicago produced more steel than the UK. Chicago produced more steel than Nazi Germany. The first controlled nuclear reaction took place at the University of Chicago. Chicago sent more men to the Army than New York.
Third one.
I would say Chicago sent more men.
Correct. That is the one false statement.
Yeah,
correct.
They did do it
under
the
really?
football.
I thought it was in New York. Oh, no.
So they did the first one. The first was right under the bleachers in University of Chicago football stadium.
Correct.
That's where the
Really?
first. That's where the first like.
I didn't realize.
That was the inception of like the Manhattan Project.
Yeah,
was there.
yep.
First nuclear reaction.
Oh, very cool. Okay.
So yeah, nice work.
All right, Sam, you get $50 gift card. Thanks to us getting that question right, and it's brought to you by today's sponsor, Cost Seg Kev CSSI.
There you go.
That's the company. We got the right company. All right. All right. So we always ask you for reviews. We always ask you to log in, give us the 5 stars anywhere that you listen to. We'll take that, but we'd rather you take this and refer this to a friend that you can help out in their Chicago investing journey. So refer us, and then still give us a review anyways.
There you go.
Listeners, we will see you next week.